Hi, everybody. My name is Rohan Gray. I'm an assistant professor of law at the University of Willamette in Oregon, and I'm also a director of public money action. I'm here with a follow-up conversation with a good friend of mine, Nathan Tankus, following on from the conversation that I did a few days ago with the former Mint director, Philip Deal, to explore more issues around the $1 trillion coin proposal, this time looking more on the economic side of things, as well as the kind of post-coin fiscal monetary macro framework that we could imagine. And I'm extremely excited to have my good friend Nathan Tankus here. Nathan, why don't you introduce yourself?
Hi, I'm Nathan Tankus. I'm publisher of the newsletter Notes on the Crises, and longtime associate with Rohan Gray and Modern Money Network, and now Public Money Action. And happy to have this conversation.
Yeah, so this will be less of an interview and more of a kind of back and forth. We've both got our own kind of points of view on this, but we've been talking about these issues for so long that we're kind of, I think, on the same page about a lot of it. So yeah, why don't you kick us off with what you want to talk about first?
Yeah, so I think to catch us up, if you follow Rohan and I on Twitter, familiar with Joe Weisenthal at Bloomberg or some of the other kind of outlets that have been covering things lately, you'll know that we have been very interested in and discussing the latest debt ceiling crisis. We have these recurrent crises where there's something called the debt ceiling that Congress has a big conflict over raising, and not raising it has these very important financial consequences for the United States and for continuing making the payments that Congress has authorized. And so, and the flip side, that there's a possible solution that Rowan's research has focused on, and I've discussed in past on Notes in the Crises, that has become a really central point of debate the last few weeks, and I think will continue to be now that the debt ceiling fight has been postponed to December. And so I just wanted to, start off with having Rohan, set the scene of what these recurring debt ceiling crises are about.
Yeah, gone but not forgotten. Probably back sooner than we will even notice. Yeah, so the basic premise is that there is this law on the books that constrains the Treasury in the number of securities subject to that constraint that can be issued. So the statute says it's a debt ceiling, debt subject to public limit, and prescribes a quantitative limit. And as I've talked about in other places, that original ceiling was actually intended to give more flexibility rather than less to the Treasury and how it finances the spending that Congress has authorized. Before that, there were micromanaging directions of the amount of certain duration securities for different programs. It was very difficult for the Treasury to roll over debt, to consolidate prior securities into a new issuance, that kind of thing. And by moving to a general aggregate limit, it actually expanded the autonomy and flexibility of the Treasury's financing capacity. But over the 20th century, this became its own sort of political football and an example of Goodhart's law or Campbell's law. The minute this became a metric, it became abused for the purposes that it was originally created, beyond those purposes, and became a way for politicians to grandstand about spending commitments that had already been authorized, often authorized by themselves, but a way to sort of complain about the broader macroeconomic implications or just sort of general government profligacy and sort of what they considered to be unsustainable budgetary practices.
I want to pause there for a second and really emphasize a point that you were making, that I think it's easy for people to not understand because we're so used to how things work. Each and every spending bill or some sort of congressionally designed lending bill was built on having its own financing choices, where in that legislation, Congress would say what type of securities you would issue it, what their maturities were, sometimes what their interest rates were, without necessarily reference to what market interest rates were at the time, and would specify the exact amount that you could spend on X or Y project based on whatever the financing available was, that didn't have a connection to anything else. So, for example, building the Panama Canal had its own securities. There were Panama Canal securities. Whenever we fought a war, there were Mexican-American securities. Obviously, of course, the Civil War securities. But any individual project, whether it was an infrastructure project, whether it was something military related, each bill had their own set of securities that went into its own pot of money out there. And so you could have dozens and dozens of different accounts for different money. And if you spent less ended up spending less in one place and needing to spend more in another place where Congress has authorized that spending, you couldn't shift money from one pocket to another.
Yeah, that's right. Our mutual friend Stephanie Kelton likes to talk about when she was in the Senate Budget Committee, there would be these people who would have a list of pay-fors. So say you wanted a spending bill, you needed a specific amount of money, and they would say, okay, what possible taxes or revenue raises out there, custom things are there that would meet roughly the spending needs of this bill? Okay, we've got one. And of course, everybody's favorite is the financial transactions tax. That kind of tax has been proposed to pay for every spending program out there. But the idea was, hey, you need a certain amount of spending, here's your revenue raiser. And if it wasn't offset by particular revenue, which in the 19th or 18th century could include coin and signage, it could include customs and imports, things. It wasn't things that we normally necessarily think of as taxes. It could include fines and fees. Certainly if you're in Ferguson, Missouri today and you need to raise revenue, you're probably going to think about, the police fines and fees before you're going to think about necessarily raising property taxes or something. But in this situation, we're talking about the various kinds of deficit financing, right? We're talking about that point when the quote unquote revenue is in shortfall and you need to finance it by issuing something new into the economy. And even today, there are some sort of legacy examples of this. For example, the Tennessee Valley Authority can issue its own securities, and they are government guaranteed, full faith and credit of the government. They have a bond duration, etc. But they are subject to their own limit. There's a specific $30 billion limit for TVA securities. And Fannie Mae and Freddie Mac issue securities that are not explicitly backed by the government, but are implicitly guaranteed. And that allows them to be not included in the debt subject to limit. Again, an accounting gimmick. And then, of course, Ginnie Mae also has securities that are subject to limit. And there's a gimmick there. And one thing that I haven't talked about in other interviews about the coin, but I think is probably worth mentioning, is that right now we have a thing called the Federal Financing Bank within Treasury. And the Federal Financing Bank's job is to basically launder or to sort of harmonize and conform the various securities or debt instruments that might be issued by other agencies within the government, so that when they finally come out the other side into private circulation, they all look like Treasury securities. So if you're a part of, the Postal Service and you need to go into debt for a program and you've been authorized to do that from the Treasury, rather than sell a bond on the market directly and have 25 different bond markets for government bonds, you simply sell that to the Federal Financing Bank and they sell a Treasury security onwards. And that internal bond is not counted towards a debt limit because the other one is. And the effect is to harmonize and to streamline and consolidate what could be a very balkanized, fragmented government securities market. And in fact, some of the biggest problems that we've faced in monetary policy implementation over the last decade have been the leftovers, have been those mortgage-backed securities markets where they, in many respects, function very similarly to Treasury securities, but have not been fully harmonized. And one of the major blockages of harmonizing them is that if we brought them explicitly under the debt ceiling, explicitly as a government security, we would have to put them under the debt ceiling, and suddenly that number would jump in a very big way, in a one-off way. And a lot of people don't want to be responsible for that. So not only is this a historical anachronism, but we're still sort of seeing some of the after effects or the lingering effects of this earlier system, and they're bad. They don't make better policy. They don't make a smoother, more integrated securities market. They just make life more complicated and more opportunities for fictions to get in the way.
Yeah, and as much as there's a legacy of that, it is important to emphasize that they used to be prevalent. Like used
So
to
much
be
worse.
I mean, if Congress passes a dozen bills that affect the spending or lending of the federal government every year, and all of them are at least maturing 10 years, sometimes 20, 30 years, and it passes 10 or 12 bills every year, that can be over 100 distinct types of securities with their distinct maturity, interest rate, coupon properties, authorized under different laws that will look a little bit different because they have slightly different legal properties, because they've all been designed by Congress slightly differently in those acts to in how these things are financed, giving the Treasury relatively little discretion in how it finances the activities and of the authorized lending and spending from Congress.
That's right. And the other thing to think about is, of course, nowadays, in part because of the filibuster and political intransigence, and in part just because of the complexity of government, a lot of the budgeting is done through these big omnibus reconciliation bills where everything in the kitchen sink is thrown in together. But that's often not how it happened in earlier generations. Often there were a lot of little spending bills. And in fact, it was only sort of in the 20th century that we started consolidating all the different agency budget requests into one Treasury budget, and then consolidated various different budgets, the current budget, the capital budget, into one budget process. Right? But in the 19th century and earlier, if you were the Department of Defense and you wanted a spending bill, you just proposed it to Congress and they approved it. The Treasury was often not even involved at all, or maybe got a cursory kind of acknowledgement there. But there was a much more of a fragmented executive branch. And that process of consolidating everything within the Treasury happened not only with the debt issuance, but with the budget process and with the intragovernmental accounting process, to the point where, you know, you want to send a budget to the Congress, you have to send it to us first, and we'll put it in the consolidated budget. And that was a historical development that we often forget when we're talking about this, because we think, oh yes, of course, you know, Treasury is the repository of all public funds, all public spending, everything goes through Treasury, like it's, you know, like it's Jesus Christ, the way, the truth, and the life. Nothing shall come to Congress except through me, you know.
Very Protestant.
Nothing if not an Anglican. Yeah. So this was the water in which the debt ceiling kind of was swimming, or emerged out of. This was the muck that it emerged out of. And over time it became politicized and weaponized, and as a result it evolved. You know, there was never really a point where the debt ceiling was just in one form. It was a constantly evolving thing from 1917 through to 1939, when it reached its sort of mature form in some sense, but kept evolving. And then by the time we got to the 1980s, you know, Treasury was already having to engage in extraordinary budget measures and gimmicks and accounting workarounds to find other pots of money in trust funds and elsewhere, to cut certain spending commitments, or to call in securities that it might have sold to local governments and things, to keep the lights on while these negotiations dragged out longer and longer. And then after, of course, those early, very, very tumultuous years of the Obama presidency, by about 2013, the strategy that they settled on was to suspend the debt ceiling as a matter of course, and then only temporarily allow it to expire and then resuspend it again. And so nowadays, practically, it is a dead letter. And so the default, you know, since between 2019 and July 2021, it was suspended 2 whole years. There's a reason we didn't hear about the debt ceiling for a long time. In that period, the Treasury has very, very wide latitude of how many securities it wants to issue and those kinds of things. The other thing is probably worth talking about at this point before we go further is also just that we often think of the Treasury only issuing Treasury securities to finance its spending, to finance its deficit. So that, for example, somebody says, well, we could mint $1 trillion coin, but if Congress doesn't authorize the spending, it just sits in the account. Well, that is true, but with issuing Treasury securities, you have to first sell it to a primary dealer. And so if you issue more Treasury securities than you need to spend, even if the money that you got from the primary dealers for selling the security just sits in the Treasury's account, right? those securities are still out there in circulation. And so there was a period earlier this year where the Treasury's cash position in its general account at the Fed was, I think, up over $1 trillion. It had sold a lot of securities out there into circulation, not to finance spending that was happening, but just to sit there in its account. And that actually did have a real effect on the securities market. And if you go back a decade, they did a similar thing with what was called the supplementary financing program, but this was for a specific purpose, which we'll talk, I think, more later.
Yeah.
But the purpose of that program was that the Federal Reserve said to the Treasury, we need more securities in the securities markets. We need more than you're issuing for your regular operations. And so they created a facility where the Treasury issued securities out there for the sake of providing them to the Fed so the Fed could implement monetary policy. And so even before we get to the coin, even before we even bring up the Coinage Act, this practice of the Treasury having very wide latitude to issue more securities than it needs to change the kite, has already been the status quo, certainly since 2008. Okay, so why do we end up having the coin debate? Because as the politicization, the debt ceiling gets worse and worse, what used to be a matter of course, passing the debt ceiling increases, or even matter of a little bit of political jockeying, but probably in the realm of kind of regular leverage that you exercise over the other party when you're in opposition, became more and more of a kind of nihilistic, existential shutting down of the government, right? Former Director Deal talked about, well, we didn't have Republican members that believed in starving the beast and literally trying to prove that the government can't function as a political strategy. That's a recent development. And so you have these situations where what Michael Dorff and Neil Buchanan call a trilemma, where Congress has told the Treasury to spend a certain amount, tax a certain amount, and not issue more Treasury securities to cover the difference than a certain limit. And in their view, that creates an impossible trilemma. It creates an impossible paradox where something has to give, right? It's sort of, can God make a stone so big that they can't lift it kind of thing? Can you create so much spending that you can't, and so little borrowing authority that you can't honor both? And the problem with that framing, the reason that I think this coin became so important from people like you and I, who care about larger issues about monetary theory and public finance, is that it ignores where the money comes from in the first place. There's a lot of people out there who think, okay, governments can only tax or borrow. And they think of borrowing as something that you and I do. Or if I don't have cash, I borrow it from somebody and they give me cash. Rather than issuing Treasury securities that, for a lot of actors in the economy, are a form of money. They are a form of money itself. It's not debt versus money. It's a special purpose money used in financial markets. But people don't think of the fact that for there to be money to be taxed, etc., that needs to be created in the first place. So the tax, borrow, spend paradigm is missing a fourth part of it. It's the missing brother in the story. It's the missing member of the Fantastic Four. It's that you have to create money, and there's a creation power. And if that power is still there, then at any point in time, the choice has always been, not even just with the coin, but throughout all of history, the constitutional choice has always been tax, issue securities, or issue other forms of instruments like currency. And historically, this was incredibly important. It was important in the Civil War. Without the greenbacks, maybe we wouldn't have won. It was important in the 1930s. Without floating the gold standard and issuing Federal Reserve notes and things, maybe we would have had a very different response to the Depression. And it's certainly important now because we do issue billions, if not trillions of dollars of Federal Reserve notes, of central bank settlement balances, what we call reserves, of coins and other instruments. And so even today, the greenback laws that were set up in the 1860s are still on the books. They're still legally there. The Treasury can still legally issue its own notes that look very similar to Federal Reserve notes, but are not Federal Reserve notes. And they have their own ceiling, just like the TVA, just like these other actors. And so if we start from assuming that the only possible ways to finance the government's deficit or to issue instruments into circulation are through taxing or issuing government debt subject to the debt ceiling, then it's just an empirical matter. It's just a descriptive matter. We're already off on the wrong foot because we've ignored all of this history, all of these rich institutional options. And so building on the work of people like Carlos Mucha, who first came up with this idea, and then Philip Deal and others in the MMT community like Joe Firestone, my legal argument is not only can the president and Treasury secretary use this platinum coin law, this plain meaning of this law to mint a coin, but they may actually be constitutionally required to do so. Because the alternative would be to break one of the constraints that Congress has put on the executive branch, right? Either you spend less than you should, and there are debates right now about should we prioritize debt repayment over, sending out checks to people, or you unilaterally raise taxes, which nobody's proposing for perhaps obvious reasons, or you violate the debt ceiling and you say, we think this is bad law, we're just going to ignore it. And maybe it is bad law, but that doesn't mean that ignoring it has zero consequences. It doesn't mean that ignoring it is costless legally and politically and socially, especially when there's other options on the table.
Now let's back up a little bit and talk. We've talked about this fourth option, which you can broadly put in the box of money creation. There are these greenbacks, or Treasury notes, which have a $300 million cap. But let's back up and talk. How do coins normally work? What are the kind of limitations on them? And then explain, briefly, specifically what this other option that doesn't have the normal limitations of coins is.
Yeah. So normally the debt ceiling, like the greenback ceiling, like the TBA ceiling, is a limit on the overall amount of face value of those instruments. So the greenback law says you can issue Treasury notes, or United States notes, they call them, up to $300 million. But it doesn't say what denomination they have to be, what face value they have to be. You could issue theoretically, one $300 million note if you wanted to, or you could issue $300 million $1 notes. It's like that old would you rather game. Would you rather have 1,000 little teeth or one really big tooth? Well, under the greenback ceiling, there's no limit. You could have 1,000 little notes or one big note. It's all allowed as long as you don't go more than 300 million in total. And that's the same with the Treasury securities. You could have a Treasury security that currently, I think there are ones that go up to $5 million. You could have ones that are $1 million if you wanted to. You could have ones that are $500 million if you wanted to. But the Coinage Act is different. The Coinage Act does not specify an upper limit on the amount of face value of coins in circulation. There's no limit to the value of total coins in circulation today. There's never been in the history of the United States or in the history of the Mint. In fact, the Mint is often praised when it manages to issue more coins in circulation because it means more seigniorage revenue, and then it gets to show how successful it is as an agency. But there's never been a point where sort of we get to July or August or October and someone says, oh, we've issued all of our coins for this year. We're up against the limit. Sorry, we have to shut everything down and tell everyone to go home early. It doesn't work like that. There are limits on what coinage, what powers of coinage the Treasury Secretary and the Mint can exercise. But those limits are not a quantitative cap. They are a qualitative set of restrictions on the kind of coins that can be issued. So you can issue as many pennies as you want, but they have to have this size, this shape, have to be made of this metal. You can issue as many dollar coins as you want, but they have to be this size, this shape, this metal. What is unique about the platinum coin law, about 5112K of the Coinage Act? And this is something that Mint Director Deal was very intentional about when he passed this law. He said, I wrote this law, sorry, not passing it, I wrote this law with full knowledge that it was unprecedented in the history of US coinage. That's a direct quote, with full knowledge that it was unprecedented, to give the Mint complete discretion in almost every part of the coin, in the denomination, in the size, in the design, everything. And that fits into the rest of the Coinage Act. There was no cap on the total amount of coins that could be issued, only the size of each individual coin. And now this particular kind of coin has taken away that restriction as well. That doesn't mean, of course, the mint can suddenly go out and buy $1 trillion or buy Ferraris for everybody who works at the mint, right? There are still limits on the spending side. There's still those congressional budget limits. But when it comes to the coinage power, it ends up looking a lot more like the debt ceiling does when it's suspended. That is to say, the Treasury can issue Treasury securities of whatever denomination with whatever limit they want to. And that was intentional. That was intentional, and it was explicit in the plain language of that Coinage Act. And so we think it's crazy today to say that there could be a government agency that could issue as many financial instruments as they wanted to without limit. But that describes the Treasury from 2019 to 2021 with debt securities. That describes the Federal Reserve with reserves and Federal Reserve notes. And since 1997, it describes the mint with the platinum coin.
Right. Sorry, I closed.
No, let me ask a question then.
Yeah.
One of the things that's come up a lot, and this is something that I talked a little about in my paper about Federal Reserve independence. Right, we've talked, I think, at length about the gimmick. We had a great podcast with our friends at Money on the Left back last year when we're talking about Congresswoman Rashida Tlaib and Pramila Jayapal's ABC Act, the Automatic Boost to Communities Act, which also proposed using the power to mint coins to finance a new bill. This was explicitly new legislation, very intentionally designed to use this power. But we talked about the gimmick there, but Janet Yellen recently said, she thinks that the coin would violate the independence of the Federal Reserve. And so I want to kind of get your thoughts on this, because my argument was, first of all, if we go back to the origins of Federal Reserve independence, particularly the 1951 Treasury Fed Accord, it was never written into statute. It's never been formalized in any way. It was a matter of custom, and in fact came out of a very messy political dispute where the Fed wanted to raise interest rates and the Treasury didn't want to let them. And the Treasury was not losing necessarily right up until the point that there were external scandals involving Truman and the Korean War. And when Treasury Secretary Snyder got ill and went to hospital, and his second in charge, William McChesney Martin, basically double-crossed them. He said, look, we've been having this terrible fight with the Fed, and you guys can't get along, and Treasury Secretary kind of wins. If you say you can't work with the Fed chair, he's going to have to resign. And you said that recently, so it looks like he's going to have to resign. But of course, the Fed, and all of their bureaucrats don't like the fact that you're exercising such strong arm powers. So why don't I try to resolve this? Why don't I try to play peacemaker? You put me in charge of the Fed, and I'll be your guy on the inside. And that way they win because they'll get their independence. You can say, I'll back off at Treasury. I'll let you run your own ship, but you can rest assured knowing that it'll be me running the ship. And Snyder, who's in hospital at the time, and Truman, who's dealing with other things, say, okay, that sounds good. You're our guy, we trust you. And then he promptly double-crossed them. Right? This is what Hetzel and Leach's account of the new Fed history of the Accord published at the Richmond Fed said they used the word double-cross. They said Truman later saw McChesney Martin on the street and called him a traitor and moved to the other side of the street. This was a real kind of something out of a John le Carre novel. It was a real kind of dastardly double-cross by insider bureaucrats. And McChesney Martin went on to become the favorite son of the Fed in this post-independence Fed. But it was never really the intent at the time. It was an internal power struggle that really could have gone the other way. And of course, the time when the Treasury was in control of interest rates during World War II was a time when we won the damn war, amongst other things, or we just won the war and we wanted to keep it going. So this idea of legal independence has always been a customary thing, very strongly asserted by the Fed, but really more about the Treasury being willing to go along with it rather than something that is sort of enshrined in statute, and certainly not enshrined in the Constitution. In fact, the Federal Reserve isn't mentioned at all in the Constitution, right? The Treasury is. But also, and this was my argument in my Kentucky Law Journal paper on this issue called Administering Money, is that it is really functionally indistinguishable whether or not you finance the deficit via minting coins or via issuing Treasury debt, as long as the Fed can still set interest rates. If the Fed can still set interest rates, and still manage the liquidity in the economy, what we think of as central bank independence from an economic point of view is preserved. There's no challenge to it. There's nothing taken away. It looks different, it looks weird, but there's nothing fundamentally changing about the Fed's ability to set interest rates, manage liquidity, and determine what amount of securities are out there in the economy. Right now, the Fed has 7 trillion, I think, of Treasury securities on its balance sheet. And so I like that thought experiment. Imagine you closed your eyes and there were 2 people in front of you, and then a hand gets thrust out and there's a Treasury security in that hand. Does it matter from your point of view, whether that comes from the person who's wearing a hat that says Treasury, or whether that person created a coin, gave it to the other person, and then that person pulled that security out of their back pocket and gave it to you while they're wearing a hat that says the Fed? Does it matter to you which hand that comes from? No. You get the Treasury security in your pocket and you go out and keep it. So if the coin goes from the Treasury to the Fed, and then the Fed simply sells one of its securities, then it's the same effect as if the Treasury had sold the security in the first place, except for the intragovernmental accounting, except for the way that it gets recorded. And I think that's a true statement. And I think also, if the Fed buys the coin and then credits the mint's account and reserves, and those reserves get spent when the Treasury does its normal spending from the Treasury general account, the Fed can still pay interest on those reserves. We're in a world where the lower end of the interest rate, the overnight rate, is set at a floor through the interest on reserves rate. So between the power to pay interest directly on reserves and the power to sell existing Treasury securities, the Fed has a huge amount of latitude. But there's a 5% window there of what happens if the Fed runs out of securities. And of course, practically speaking, if we get to the point where we've minted $7 trillion coins and the Fed has sold all of those securities off its balance sheet, and we still haven't resolved this debt ceiling crisis, then come on. I mean, let's be honest. This is a very unrealistic scenario. Congress is sitting there watching these coins get minted one after another and not intervening. I think that the odds of that moment ever arriving are infinitesimal. But theoretically, it's interesting, and that's enough for certain people to criticize the whole thing as not having an answer. So I wanted to sort of have this chat with you because this goes into some of the research that you've been looking at about what a world of monetary policy could look like post-coin. So why don't you tell us a bit about that and how you think about it?
Yeah, so I think where the starting point is, you're absolutely correct. In the United States, central bank independence is at best customary. There's this thing as you were describing some of the internal politics of that's called the Federal Reserve Treasury Accord of 1951. But there's no written down accord. It's a verbal agreement which has been secondhand communicated. There's just
they did a press release to the New York Times saying we've reached an accord, and then it was called the Accord.
Yeah, it was called the Accord. And then you saw what the meaning of the Accord was by the subsequent policy that the Federal Reserve was no longer required to buy Treasury securities at specific prices, and thus was able to influence the level of non-borrowed, settlement balances, reserves that were in the banking system when it couldn't before, when that was dictated by essentially Treasury or fiscal policy. That just fiscal policy determined how much was spent, and how much was spent required a certain amount of Treasury securities to be issued, and that required a certain amount of Federal Reserve purchases in order to keep interest rates set at certain levels. So as but the customary meaning, obviously, for people who are interested in economic policy, the customary meaning is historically important, and it informs some of the legal institutional dynamics that are going on now, and that are important, but they still want to know what concretely something like the coin affects Federal Reserve policy. And it's this economic meaning economic policy meaning of Federal Reserve independence that I think is very important. Or is very important.
Would minting the coin make it not possible for the Fed to do what it does, which we think is important and should be able to continue to do.
As you were talking about, there's two elements of that. One element, the most basic element, is the ability to set interest rates. Can the Federal Reserve set interest rates? And certainly on, very clearly on the short end, on the overnight rate, the Federal Reserve can still set that interest rate because, as you were saying, it pays interest on reserves. It pays interest on excess settlement balances. So simply because there's lots of excess settlement balances in the banking system doesn't necessarily mean the interest rate is going to fall to zero, because why accept zero interest when you could get a certain amount of interest from that the Federal Reserve will simply pay you overnight. So we very clearly have this ability to set the short end of interest rates.
And this was a big development in part over the last 10 years when we had to when central banks around the world chose to do large scale asset purchases and other things. Suddenly we went from a world where most central banks had sort of limited reserves, mostly were operating on a kind of as you need it basis on providing settlement balances, and switched to a system of abundant reserves where the banking system as a whole had many more than any particular bank needed and had to deal with this problem already. And we saw over and over central bankers saying, this is fine, we can still implement monetary policy, we can still keep our ability to set interest rates. The sky hasn't fallen.
In the United States, there was a law passed in 2006 authorizing paying interest on reserves, and then in 2008 they updated the law and changed it so that that law was meant to start being operable in 2011, and they bumped it up to 2008 because the Federal Reserve was engaging in asset purchases, but also it's 13.3, it's emergency lending programs, which increased the amount of settlement balances in the banking system, and thus created this abundant settlement balances system, this floor system, as it were, where you need to now set a floor price, or otherwise the interest rate is just going to fall to zero. And historically, the concerns that the economists' concerns about monetary financing of government debt, of having the Treasury be able to either indirectly directly have the central bank finance itself, or as we're talking about, be able to directly finance itself with money, this money finance of government spending. The big concern was that it was going to lead to zero interest rates, and that zero interest rates would be inconsistent with the Federal Reserve's broader economic policy outlook, and thus you were going to see widespread inflation because of this. So already, when you have the ability to set interest rates on settlement balances, then already we're kind of out of that world, at least in the short interest rates. There's the Federal Reserve can still raise interest rates to 6, 7, 8% if it thinks though that level of interest rates is necessary to reduce demand in the economy and stabilize the economy. Whether or not that's the right economic policy approach or whatever else, is a question that can be set aside. But in the narrow terms of how the Federal Reserve operates, and currently in our current system uses interest rates to manage the economy, the Federal Reserve at least has the ability to move the short interest rates.
One other thing they said about that, and this was very important in recent years, particularly after 2020, when they had to go even further on this stuff than they had already done. And it was very clear that any attempt to sort of unwind the new normal back to the old normal, which might have been politically or rhetorically easier for them to live in, was dead in the water. Well, the good news is, yes, what we're doing is pretty close to money financed fiscal policy, but we have the control. we as the central bankers can choose when to monetize and when not to. And as long as we have the choice of when to convert this spending from securities into money financing or money financing into debt financing, as long as we're the ones that determine that on the end goal, on the end point, then it's okay. And this was a really, to me, an interesting acknowledgement, because they're saying the difference is not economic, it's political. The difference between money financing that's bad and money financing that's good is not economic. It's the same money financing. It's whether or not we have the ability, we have the choice to determine the balance of Treasury securities versus cash in the economy. If we can choose that balance, independence is preserved. If we can't, if they tell us it's all money financing forever and there's no more securities forevermore, then we've lost our independence, and that's bad for reasons related to some other stuff, but not related to the inflationary impact of money financing per se. So it was a very interesting moment where any kind of economic theory of inflation following from quote unquote money printing was abandoned entirely in favor of a purely institutional politics theory of central banking.
And that's a consistent thing that you see in economist discussions of central banking, is that there's a lot of institutional, legal, political arguments about how best to manage the economy that are hidden under a layer of seemingly technocratic discussion of the economics.
Yeah. Come for concern about the quantity of theory of money, stay for concern of democratic legislators.
Yes. And we can circle back to that a bit, but nonetheless, outside of this setting the interest rates on the short end, there's still a concern about the broader way that interest rates affect the economy. And big Treasury securities, from a certain monetary economics point of view, aren't, that they're not what our politics are about in terms of Treasury securities, about national debt, burden on our grandchildren, that whole spiel. Debt just like your household debt. They are instead an important financial instrument for the broader economy. One purpose that they serve is as a benchmark interest rate. You can quote the 10-year Treasury security interest rate, or the 20-year or the 30-year, and that becomes a benchmark by which debt securities on the private market are compared to. So if you'll know how good or bad a deal a private debt security is by how much of a markup or how much of a spread it has relative to Treasury securities. It's like, you can get a really good return, but it's pretty risky because it's a 7% markup over the 10-year Treasury. Or, this is a pretty safe company, but you're really earning that much more than Treasuries if it's just a 1% markup or even a 0.5% markup of what the quote unquote safe interest rate is, which is presumed to be Treasury securities outside of this little asterisk of problems with the debt ceiling.
And I teach contracts, and one of the things I tell my students is, if you're doing contract work on a daily basis, chances are you've got a bunch of templates or a bunch of old contracts that you're copying and pasting and changing a few minor details. Well, one of the provisions that you'll often see is a provision specifically referring to the benchmark rate or whatever else. And you probably don't change that except to change the number of that markup. Every one of those debt security contracts will have that in there somewhere. And then the other thing, of course, is when you're creating those kinds of things, if you look at a corporate finance textbook, they talk about the risk-free rate. And it's the risk-free rate is the government rate. It's the 3-month T-bill rate or the 10-year rate or whatever else it is. And so when they talk about, when there is an interest rate in the economy, the interest rate, they're not referring to some market rate out there. They're specifically referring to those policy rates.
But nonetheless, because of this, there's what you mentioned earlier, that we have the Treasury deposits a platinum coin at the Federal Reserve. The Federal Reserve marks up the Treasury's account. There's at this stage been no effect on the rest of the economy. There's no effect on the private banking system. no larger effect. It's simply been a transaction within two different parts of the government, of the federal government, have been interacting. But after that stage, there is, now the Treasury has, its account has been marked up. It's able to spend out of that account without blockage. And that, once that happens, just like when the Federal Reserve makes a loan to, or creates a crisis facility that starts making loans, for whether it's corporate bonds or municipal securities or whatever else, settlement balances start filling the banking system. And if the Federal Reserve wants to offset that, it has to start selling some of its, $7 trillion of Treasury securities, and
or asking the Treasury to create another facility where it's filled up more securities and then selling those or something. But then, of course, that hits the debt limit, just like if they had sold them to finance the spending.
Exactly. So the base issue is that you have these Federal Reserve is going to have to start selling securities out of its portfolio and start reversing the flow of settlement balances, just like it would if the Treasury were spending out of its general account, out of its checking account for any other reason. It has to offset those flows, even if they were originally accumulated as a result of the issuance of Treasury securities. It still will likely have to reverse or quote unquote sterilize those flows. But nonetheless,
I just want to stop on this point, because this idea of at any point in time that the Fed is engaged in this sort of, I'm not going to use the word equilibrium because I'll have to put $1 in the equilibrium jar if I do. But at any point in time, the Fed is adjusting the relative amount of securities versus reserves out there. It's like I've got I've got a yellow dollar and a green dollar, and at any point in time, there's both out there. It's almost like bimetallism, almost, And at any point in time, there's these both kinds of dollars out there, and the Fed wants there to be some ratio, some balance, some of the total amount that you can cut it in half or cut it in 50, 60, 40 or 70, 30 or whatever it is. And that is happening every day on an ongoing basis all the time. It must be exhausting. Just constantly.
It's defensive. There's the kind of textbook idea that the Federal Reserve is deciding what's going on with settlement balances in the banking system at any given time. But really, there are all these other actors who are acting, who are sending payments every which way, and the Federal Reserve has to constantly play defense. 100 billion flew out of the Treasury's checking account. Well, that means we have to sell 100 billion securities, or we have to do whatever other operation that we'd be doing to that. We have this other thing called a reverse repo facility, and some people in XYZ country or some other governments are increasing the uptake in that facility. Then we have to reverse our actions over here. And so there's always this defense. It's like a goalie who's constantly reacting to what others are doing.
Yeah, you zig, I zag. You zag, I zig. At every point, I have to be mirroring you and blocking you from whatever's going on. Because you said even if the funds in the Treasury came from earlier prior spending. And I just want to make a point here,
or earlier
deficit sales, bond sales. Yeah. Stephanie Kelton, our mutual friend, she made this point in her book, The Deficit Myth. There's a really important point. She says all government spending works the same way. The money goes out from the government into people's pockets. And that's true. That's true even the way that we're talking about it today. The point that we're talking about is the step before that, is how can you get the money into that account so that it can then go out from that account into the economy. And the easiest way would be, let it run an overdraft. Let it just make the money every time it spends. But there is a statutory prohibition on the Treasury running an overdraft. It was allowed to for decades, and they changed that law in the 80s. It's not something set in stone, but it can still run an intraday overdraft within one day, but overnight, it's usually not allowed to. But there are many ways that you could replenish it, right? If you'd started with $1 quadrillion at the outset, then we would probably never need to replenish it ever again. And one way to replenish it is with tax revenue. One way to replenish it is with the proceeds of bond sales. One way to replenish it is with the sale of coins or notes or anything else. US notes and things would be if you sold them dollar for dollar, they would go into that general account as well. So the act of spending the money out into the economy could happen on Tuesday, and you sold the bonds on Monday, right? But if you sold the bonds on Monday, when's the Fed going to do that defensive reaction? On Monday. And so if you send it out on Tuesday, the Fed's going to have to do another defensive reaction on Tuesday. And so it doesn't matter whether or not the original funds in the Treasury's account come from one place or another. The Fed will do its own defensive reaction then. Separately, when the funds go back out again, the Fed's got to do its own separate reaction. So it doesn't matter whether we fund it with issuing bonds or minting the coin on day one. The Fed's still going to have to intervene on day 3 to make sure that that mix is where it wants.
Yeah, the big essential difference is, in one, the Federal Reserve is kind of winded up by having its portfolio of securities grow, that then when the spending goes out, it unwinds. But when you have, so there's that wind up and the unwind, so it's left in the same position. The issue and this is a long-term issue, not rather than an immediate issue with the platinum coin, is
this is 7 platinum coins. This is 7 platinum coins down the road, right?
Yeah, there's an unwind, but there's no wind up. So eventually you've just kind of unwound the whole yo-yo, and there's never a point where you wound it back up, and you need a point to wind it back up in a certain sense. And so this gets into one major research project that I've had for a number of years now, which we've discussed a lot, which is in what circumstance would you have the Treasury's spending always being directly money financed rather than indirectly in the way that we've been describing, while still having that wind up, while still having access to being able to issue as many securities as the Federal Reserve want, provide, be able to provide sufficient benchmark interest rate securities across what's called the yield curve, the different maturities of the different securities, and
it's like a time lapse. It's like there's a Treasury at 0 and it's a baby, and then there's a Treasury at 3 months and it's a toddler, and then there's a Treasury at 10 years and 30 years. It's like Benjamin Button.
Yeah, and that, and also, in which we can talk about more in later. Treasury securities also function as collateral. There's financial actors can use it as collateral in loans that they make with each other.
And in fact, currency is not allowed to do that. You're legally prohibited from using currency as collateral.
Yeah,
it's one of the unique features of currency.
Yeah. So, but securities, they can be securitized. They can be collateralized and used as
hypothecated and rehypothecated and rehypothecated.
Hypothecated and rehypothecated. And also, of course, that they've, pension funds and other kind of institutional actors can soak them up, can feed on them as this interest-free source of income, rather than having to take a risk-free source of income, so that rather than having to take a risk in order to get the income that they need to pay back benefits in the future.
And it's probably worth noting there that one of the reasons why in recent years, as you mentioned, the overnight reverse repurchase facility and the recent standing repo facility has become more prominent at the Fed is because one of the limits of paying interest on reserves is you need a reserve account. And statutory law says right now only banks can have a reserve account. Central banks around the world, England and elsewhere, have responded by saying, okay, we'll expand the number of actors that can have reserve accounts with settlement accounts at the Fed. The Fed hasn't done that. The Fed has instead said, okay, we will move towards using Treasury securities as the underlying asset because anyone can hold them, not just people who have accounts at the Fed. And then we'll do these buying and selling actions with them that create the functional effect of an account without you have to actually have an account. Another legal accounting gimmick. But I remember you writing a great blog post about this, where you say it's very bizarre that nowadays the most important instrument the Fed uses for conducting monetary policy is one over which it doesn't have control. It needs the Treasury to provide it, and is sort of dependent on it. This at the heart of central bank independence is
dependence. And so the platinum coin is an extreme example, but it's this kind of issue is already something that we experience to a lesser extent when it comes to the maturity of securities. The Treasury issues securities based on what it thinks is best to finance itself, to quote unquote minimize its interest burden and so on. And there's no reason why the securities that it would issue for that purpose would be consistent with the Federal Reserve's monetary objectives. And so, the part in that piece that you referred to, I referred to an interview that that Peter Stella did with David Beckworth on the Macro Musings podcast, where he describes how one of the big problems in the last decade has been the Federal Reserve has been filled with all these long maturity securities and hasn't had enough short maturity securities that they can issue. It hasn't had enough 3-month, 1-year securities, which are the most money-like of the Treasury securities. And instead, it's been filled with these 20 or 30 years, such that if it ever wanted to unwind its portfolio and shrink the amount of Treasury securities that it held, then it would have to be affecting the 20-year and 30-year interest rate first, rather than doing a less disruptive thing, which is selling these money-like securities on the open market. So even though the platinum coin is an extreme example of this issue of the dependence the Federal Reserve has on the Treasury to issue Treasury securities for monetary policy purposes, it's something that is already a recurring example.
It happened in the 90s when the Treasury was running a surplus, and the Fed was worried that they were going to stop issuing more securities of certain maturities. And it's happened in other countries like Australia, where again, they were running a budget surplus. And the concern from the Reserve Bank of Australia was that you're going to run out of securities that the market is thirsty for, they're hungry for. And the Treasury is saying, we don't need to issue them. Why would we issue them? We don't need to. And the Fed saying, we need you to.
Yeah.
Us, the vaunted independent institution, need you to do it. And they said, fine, because we play ball, because we're a good partner, we'll throw you a bone. We'll do you a solid and we'll issue some in the name of fiscal monetary coordination.
Yes. And so, proposal that came up with in us discussing this over a long period of time, and discovering, in fact, that there were many central banks around the world who were already authorized to issue their own securities, but they do it in this kind of, more minor sense. It usually has to do with foreign exchange operations. It's countries that have a structural budget surplus because they have a lot of incoming flows, and so they don't issue any securities because they're not running a deficit, and the central bank wants there to be a securities market. So they say, fine, we'll make ourselves one. But they do prefer it to be Treasury for ideological and other reasons we can get into. But yeah, just a shout out, it was an IMF working paper called Central Bank Securities, International Experiences, I think, from about 2015. And they said something like 35% of central bankers around the world have issued central bank securities in some form or other. And they're often very short term. They're often 1 month up to 3 months, or 1 week up to 3 months. But it's not an unheard of thing. In fact, the Bank of England wrote a little note about central bank securities as well. And yeah, it's been considered in a lot of places. So our proposal to kind of cut the Gordian knot is, rather than kind of have this instrument that's only operating on the short end, only a part of the government securities market, make it the whole government securities market. Make it that the Federal Reserve is responsible for issuing Federal Reserve securities, and the Treasury is money finance, whether it's uncapping the greenback cap, whether it's using the platinum coin provision, whether it's coming up with a new coinage provision, maybe a digital coinage provision, in order to how to directly money finance its spending. But
or eliminating the overdraft provision is another one.
Limiting the overdraft provision is another one. And so have some way where the Treasury money finances its spending, and then the Federal Reserve can choose to sterilize those injections of settlement balances by selling securities and selling its own Federal Reserve securities. And in the process of thinking about and preparing to write a lot more about this proposal, which is actually a lot of time that was spending doing in late 2018 and 2019 before coronavirus took off, I discovered that actually there was a World War II Treasury economist who's kind of forgotten now, but was a major player in his day, Columbia University money and banking professor called Albert G. Hart, and that he had made this proposal in the context of debates over how the Federal Reserve and the Treasury's relationship should be reorganized up until the Federal Reserve Treasury Accord, the Fed Treasury Accord of 1951. He made this exact proposal. He proposed, in the kind of earlier version that you referenced, that you could simply let the Treasury have an unlimited overdraft at the Fed, and that the Fed was authorized to issue securities and would redeem the existing Treasury securities that are out there, and that would give it full independence from the Treasury in issuing this, the basic building block of monetary policy, which is the securities that you use to drain settlement balances out of the banking system and provide safe assets to institutional actors throughout the economy.
Another way we can think about this is, right now, the Treasury and the Fed can issue new dollars through reserve balances in exchange for a range of assets. Normally it's Treasury securities, but it could be corporate debt, could be even potentially stocks in the future. That's certainly the way the Bank of Japan has gone. So on the buy side, it's got an infinite number of dollars. In fact, Minneapolis Fed President Neil Kashkari in 2020 said, we have an infinite number of dollars if we need to resolve this crisis. But on the sell side, they don't. The Treasury securities are limited by what they have in their inventory. So if you're trying to be a monopoly pricing person, if you're trying to set the price and guarantee that it's going to stay there, the classic Fed strategy of set the price and let the quantity float, right? The credible commitment that you can have about keeping a price at a certain level only works if you can buying up everything and selling everything. And you can buy on one side infinitely, but you can't sell infinitely unless you can issue that asset with the same level of discretion. And now,
And this actually came up until the Fed Treasury Accord, where they are trying to control the exact price and thus interest rate on treasuries. The monetary policy historian at the New York Fed, Kenneth Garbade, wrote about this, that they could obviously, because the Federal Reserve can issue as much settlement balances as it wanted, was successfully able to create a ceiling and prevent interest rates from rising above where they wanted on any given level of maturity. But they had trouble setting the floor because they would get reach the point where if they wanted to sell more securities at that maturity level, they would run low on the stock of Treasury securities they had. So interest rates in various parts of the Treasury market drifted below where they wanted them to be because they simply did not have the portfolio to do so. And I think this is a big part of actually where Albert Hart's proposal was coming from, was dealing with this issue that had emerged and was more obvious pre the Federal Reserve Treasury Accord of the dependence of the Fed on Treasury securities, and to give it more independence in how it determined monetary policy, was for it to be able to issue Federal Reserve securities. And,
of course, one alternative to that would be something like the supplementary financing program that was created in 2009, where the Fed and Treasury came up with a new accord where the Treasury said, we will provide as many securities as you need to. But of course, that brings us right back to where we started with the $1 trillion coin, which is they are going to be subject to the debt ceiling, at least under current law. You could imagine someone passing a law and excluding those securities from counting as the debt ceiling. So the debt ceiling is about fiscal spending. This is about supplementing monetary policy coordination. So we will exclude those. That's not the current law, but you could imagine a law like that. But at that point, why are you bringing the Treasury involved at all? Why don't you just let the Fed do it and cut out the middleman? That's definitely, like I say, the closest distance between 2 points is a straight line. We could create an incredibly convoluted process, or we could just make it much simpler. And I think the other point there is that, as I said earlier, when the Treasury issues Treasury securities to finance its deficit, and the Fed is engaging in those defensive actions, then whatever the Treasury starts, the Fed finishes. Whatever number of securities the Treasury issues, the Fed will choose what fraction of them stay in circulation, private circulation, as securities versus converting into currency or reserves. And vice versa can also be the case. If the Treasury finances all of its spending through money finance fiscal policy, when we were passing the ABC Act, what we were calling fiscal money for fiscal policy, right? Then the Fed still has the ability to choose the final balance between money in circulation and securities. It's just doing it from the other side. It's instead of starting with securities and monetizing a fraction, it's starting with money and securitizing.
Yeah, rather than, if you look from far back, it might seem like we're proposing a radically new system. But if you zoom in on the details, what we're really just doing is changing the order of operations and simplifying. So rather than the Treasury issues securities, then the Federal Reserve buys other securities to make sure that that Treasury auction doesn't fail, and then fills up its account at the Federal Reserve, and then unwinds that later by spending, which then the Federal Reserve then sells securities.
Re-sterilizes again,
yeah. And sterilizes it the other way. Instead, you simply start with the Treasury spending. You don't do that pre-step of the auction that the Fed offsets. You just have the Treasury spend, and then you have the Federal Reserve do an auction. And it's the Federal Reserve doing an auction isn't that different from the Federal Reserve reselling a security that it had recently bought or had bought in the month or two ago. It's from the point of view of the financial system, the broader economy, it doesn't look any different. But these institutional arrangements are simplified. They're much clearer and much more understandable to the public. And the Federal Reserve actually has more independence and control over the security issuance process, the maturities, the denominations, and so forth.
Well, I'm sure Janet Yellen's listening. I'm sure now all of her concerns about Federal Reserve independence have been put to bed, because now she's going to find out that this is actually better for Federal Reserve independence in the long term, God forbid. But, I just want to take a step back. We were talking before about the difference legally between a security and currency or things like that. But it seems to me there are two aspects of why securities markets may need to exist, or it might be worth at least keeping that debate of whether they should exist separate to the debate about improving fiscal policy. Right? When we think about government debt today, Treasury securities, the stuff that normally comes to mind is the national debt clock on the side of Fox News. It's the rhetoric about borrowing from our children. It's the rhetoric about the government's red ink. It's the rhetoric about spending beyond our means. These are the kinds of things that people associate with Treasury debt. It's bad, right? Government securities don't have the same mentality in the same way, right? Certainly people, even mortgage-backed securities, people don't think, oh no, we're spending beyond our means, because there's a lot of mortgage-backed securities. But, again, Stephanie has this great story where she said she talked to people on the Hill when she was in the Senate Budget Committee. And she'd say to them, what do you think about the national debt? They'd say, oh, it's bad, we should get rid of it. And then she'd say, what do you think about the government securities market? They'd say, oh, it's important, it's critical, it's one of our shining jewels in the financial system. And she'd sort of wait for a second and she'd say, it's the same thing, right? but mentally, symbolically, rhetorically, politically, it's not. It is exactly the same thing, but it's not. It's almost like that Wittgenstein idea of the rabbit versus the duck. Depending on which way you look at it, it's a rabbit or it's a duck. And it's the exact same thing right now. But if you're a member of the public or if you're trying to fearmonger about the deficit, it's bad. And if you're thinking about it from the perspective of financial markets, it's good. And what we're proposing in part is a way to separate those two things out, both operationally and maybe even, and more importantly, symbolically, conceptually, rhetorically.
Currently, we've got this one set of securities that has two different discourses about it. We have this public discourse, or you want a technical term, this exoteric discourse, where where we're talking about how terrible it is. But then, if you're in the inside, if you're in the know, if you've got the smart stuff, if you've got some experience from Wall Street or some Wall Street friends, if you're really in the know and you know people who really understand how the government securities market work, not how the national debt works, how the government securities market works, then you know that this is a safe asset, one of the most important, if not the most important financial instruments in the world, and a super important part of actually how the US is governing the world, then you're in the know. And that's the esoteric discourse. That's the secret discourse that if you've been let into this club, then you or adjacent to this club, how things can really work. And part of the point is to separate them. Now we'll have these Federal Reserve securities. Financiers can gush about them, but you've eliminated and picked out the national debt discourse. It's very hard to get a Federal Reserve securities debt clock going. It's very hard to get people to go, oh, we're just issuing too many Federal Reserve securities. There's too many of these safe assets out in the economy for pension funds.
I can't believe the central bank wanted to maintain a long end yield curve policy. Yeah. How dare they? Our grandchildren will never recover.
Too many questions are begged about how the monetary system works by trying to gin up hysteria about that. Of course, as we're starting to see, you can try to gin things up about money and creating money and all of this. But I'm not going to say that it's never possible to, make some topic verboten or, generate a reactionary media narrative about it. But it's a very different thing. It begs uncomfortable questions. The national debt doesn't require you to think, well, money, they're creating too much money. That requires a little bit more thinking. There's more,
or they're issuing too many securities. They're issuing too many safe financial benchmark assets. Even by the time you get there, you've lost most people.
Yeah, you never will be able to get. I think, frankly, you'll never be able to get media controversies going over Federal Reserve securities.
When's there been a single media article about central bank securities in the whole world? Find one. I'll wait.
Yeah.
And of course, the flip side is what Kate Aronoff wrote in her Great New Republic piece about the connection between blowing up that national debt myth and dealing with the real problems like climate change. If we are still hamstrung in our fiscal policymaking by these concerns, these fake concerns about the national debt, then we are never going to deal with really important issues like climate seriously. So in that respect, mint the coin, saving fiscal policy from this quagmire of national debt hysteria is incredibly important. And here's the good news. We don't even have to impact monetary policy at all, except to make it better. Now, you and me may have views about the merits of having a yield curve. Maybe we think it should be better to have long-term zero interest rates, but that's not the fight we're fighting today. That's not the purpose of this reform. getting the benefit to improving fiscal policy on its own and leaving the interest rate, the Federal Reserve independence issue for another day is important, because there may be a lot of people who do care about improving fiscal policy who don't agree with us about central bank independence. And the good news is, honestly, we are not proposing eliminating central bank independence or monetary policy powers here. They completely survive. In fact, they're probably more efficient, more effective than they were the day before.
And the only sense in which you could really construe a compromise, quote unquote, to central bank independence is if by central bank independence you really mean the ability of a central bank to deny financing to the federal government and thus basically be its own debt ceiling, of causing its own fiscal crisis till its demands are met. And then if you're talking about that level, which I don't think is necessarily the consensus view, but it's certainly something that economists have meant historically when they meant by central bank independence and the no monetization rule, quote unquote, that is really talking about Treasury dependence and the dependence of the rest of the federal government on the Federal Reserve. And in fact, to go back to the trilemma of the quadrilemma conversation, the ability of the Federal Reserve to contravene Congress's directive to authorize spending and to implement a certain amount of taxes. What you're essentially talking about when you're talking about the Federal Reserve's ability to destabilize the federal government's finances, what you're really talking about is their ability to veto Congress's directives and contravene what Congress has directed, which, there's a complicated chain there, but I don't think there's any way where you could reasonably construe that as anything but unconstitutional.
Yeah, when people think of Fed independence, they think of independence from the rest of the executive, not from the legislature that gets to actually pass laws, if for no other reason than the Federal Reserve is a creature of Congress. It's a creature of statute. If you want to change that law, Congress can do it. But yeah, you're right. By the time the Treasury is calling the Fed and saying we need to spend, that's after Congress has already told the Treasury to spend. That call is not coming from the Treasury in the way that in 1945 to 1951, hey, we want interest rates low. That call was coming from the executive branch to the Fed. This is a call saying we have to spend this. We've been told to spend this. We don't have a choice. And starting to pretend like we do have a choice is getting dangerously close into a constitutional crisis, violation of the separation of powers. And to your point earlier about that esoteric versus exoteric knowledge, I remember we did an event with the Modern Money Network and Zoltan Pozsar, Colombia, the famed guru of the money markets, the sort of godfather of shadow banking discourse, Zoltan Pozsar. Every newsletter he writes, all the financial market press is savoring over it, slavishly. I remember talking to him about this. I said, why don't we just stop issuing Treasury securities? And at that point, I wasn't thinking about Fed securities. I said, look, we actually have a thing that the Fed has already done like this on the book. It's term deposits, which have a maturity. They pay an interest rate and they're issued by the Fed. And I said, look, why, if you want a 3-month interest earning asset that's guaranteed by the government, why don't we just create a certificate of deposit or at the central bank, at the Fed, like we did in 2009? There was the term deposit auction facility. Why don't we just do that? And he stopped for a second. He thought about it. He said, no, it wouldn't work. I said, why not? He said, because you can't securitize them, because you can't sell them in securities markets. And I went, good point. What about central bank securities? But by that point, it was the next day. I hadn't thought about it in the moment. It's sort of like George Costanza in Seinfeld. I had the perfect comeback, but I didn't think about it until I left the room, But he has written, I think he himself has written, that central bank securities would be one way to supplement the shortfall in the securities market. If there really is a dearth, an undersupply of safe assets in the capital markets, and by safe assets, we normally mean central bank securities, then Treasury securities, sorry. then issuing central bank securities would be a way to do that. I think it's very interesting that, somebody who is at the guts of that relationship between collateral and safe assets and shadow money and the institutional plumbing reached a similar conclusion on some of these
issues. So we've talked about a lot of different things. We've touched a lot of different bases. I think one last base that I think is important to touch, but I don't think will take that much time, is an issue that has come up, an issue which I think is secondary to this Treasury securities issue, but nonetheless, comes up frequently that it's worth to touch, is what about the Federal Reserve's income? And does the Federal Reserve's income matter?
The health of its balance sheet.
The health of its balance sheet. So I was wondering if you wanted to start off some thoughts about that concern.
Yeah, absolutely. I mean, the first thing to remember is, of course, the Federal Reserve is not like a private actor. It doesn't have the same balance sheet constraint. Even people that like to deny a government having, that kind of soft budget constraint in general usually create an exception for the central bank, right? They're the one actor in the world that has an infinity sign that everybody can talk about. That's Neil Kashkari saying we have an infinity sign. That's Powell saying there's no limit to how much we can, how much firepower we have, which I think he said he testified to Congress last year. But at the same time, there is this concern that if the central bank is not cash flow positive, if it doesn't have a net positive balance sheet position, then it will be damaging. It will be dangerous. It will undermine central bank independence because it will give the impression that the central bank is not able to look after itself, and that will give a political impetus to Congress or legislators to undermine central bank independence. Now, the interesting thing is that this is not a new problem. This is not a new concern. And one of the reasons it's not a new concern is over the last decade, the Fed and other central banks have had to buy up a lot of assets that either don't perform or earn very little interest, and created reserves, created settlement balances in the process that then paid out interest. So they were holding assets on one hand, they had liabilities on the other, and the liabilities might have paid more interest than the assets. This is true not only for private assets, but buying up, Treasury securities that are earning very little and then trying to raise interest rates means that you're raising the interest rate on reserves that are, offset by assets that earn less interest. And the Treasury dealt with this problem. The Fed dealt with this problem by creating an accounting gimmick, what they call a deferred asset on their balance sheet. Because normally, when the Fed does run a profit, and this is also the irony of talking about Federal Reserve independence, where do those profits go? They go right back to Treasury. In fact, now it's mandated by law. For about almost 80 years, it was by a kind of, once again, an agreement, a customary accord, but then they required it by law recently under, I think, Obama's administration. And so now when the Fed does earn a profit, it sends it back, which creates, in many situations, a very ridiculous dynamic where the Fed buys up Treasury securities, the Treasury pays interest on them, the Fed earns that interest and then sends it back to the Fed. It's sort of like your mother gives you money to run a lemonade stand, and then you say, oh, look, I made so much money, I'm going to donate it to the family to pay rent. Your mother's like, yeah, thanks for giving me my money back, and you're like, aren't I a big contributor to the household? No, you just had play money there.
Yeah.
But the Fed is in those situations, if it doesn't have a positive cash flow, if it doesn't have a net operating profit, then it books that loss not as insolvency or anything like that, not like, hey, we're about to go under or our balance sheet doesn't add up. They say, well, we have future profits coming. And until those profits arrive, we're going to book this loss as future profits not yet arrived. So you want to go into a bit more about that accounting?
Yeah, so they have, the Federal Reserve's net worth basically never changes. That when it has a positive income, to correspond to offset that positive income, it books that it has this increased liability to pay remittances to the Federal Reserve, so that its asset position never changes. Outside of some, complicated things about, holding stuff in reserves or whatever, which I'll put aside. Essentially, it has, it never, has a time where its assets really go, or its net worth really goes up because of a big amount of income, because of $100 billion of income. It just books having a greater liability to pay remittances back to the Treasury. And the interesting thing about this,
it's also like, it's almost like a maximum income cap. If you have a maximum income cap in the economy at $1 million and you earn 2 million that year, you've got $1 million in income and $1 million tax liability.
Yeah. Yes. And so it just books, its net worth never changes. So it just books, it has an increased liability to pay remittances to the Treasury. Now, the interesting thing about this way of dealing with its income is that if its income is negative, that liability to pay remittances becomes a negative liability, essentially an asset. It's, this negative liability that we actually, we negative owe paying you remittances, which actually makes it an asset of ours. And this might seem silly. It definitely is. If there's anything as an accounting gimmick, this is an accounting gimmick.
It's not a loss. It's not a loss. It's just a win I haven't made yet. Like, come on.
And but the Federal Reserve has specifically been given control of its own accounting rules. It doesn't have to subscribe uniquely of government agencies. It's not subject to rules set up.
Yeah, the FASAP manual, the Financial Accounting Standards Manual, doesn't apply to it.
It doesn't apply. It does its own accounting. It hires its own auditors. And which has been historically been a very controversial thing. Recurringly, whenever congressional oversight came up, whenever there was a nomination hearing, congressional officials would grill Federal Reserve officials about their books, about what they can know about what they're doing, about their accounting rules. It's recurrently been a controversial thing for member of Congress who are providing oversight, or in a lot of cases, trying and not succeeding to provide oversight of the Federal Reserve. But nonetheless, under the current rules, it sets its own accounting rules. So it can come up with this or some other fancy solution that deals with its that deals with this problem of losses. Now, there's no mechanical problem of making payments with settlement balances. This is purely, it's a problem of accounting in a lot of ways, the same way the debt ceiling and the platinum coin is a problem of accounting. But the Federal Reserve especially uniquely has a lot of discretion and latitude to come up with an accounting solution. And so, it can do this of, we're booking this negative liability, i.e. an asset. So even if we are, cash flow wise, a certain amount of cash is going out and a certain amount of cash is coming in, and that number is negative, according to our accounting rules, they can prevent it from ever showing up as a loss. And thus you never have that, like the Federal Reserve's negative net worth headline comes up. Or they could come up with a different way of dealing with this accounting. One way that that you and working with Rashida Tlaib described was as part of authorizing it or requiring the Treasury to issue $1 trillion platinum coins to finance this spending, and consequently also authorizing the Federal Reserve to issue securities.
We wrote the language. It's ready to go. We can pull it off the shelf whenever Congress is ready.
Yeah. And so the language in there actually specifies a provision for having a Treasury monetary financing account where the quote unquote losses associated with paying interest on balances or paying interest on issuing additional Federal Reserve securities gets booked to this losses account, and thus is, theoretically, technically, the Treasury's responsibility, even though it doesn't have any effect on how the Treasury is spending, which would again just be with money finance, and it doesn't have any effect on how the Federal Reserve is conducting monetary policy. For accounting purposes, we can just make, that bill proposes just, book any losses that come up to this account, and that'll be that.
Yeah, it doesn't affect the Treasury at all, but it basically ring fences those losses from the rest of the Fed's balance sheet. So there's no risk at all that the Fed would lose any operational independence, that this would show up as a loss overall, and it would have to justify it. Like if you had a badly performing, part of a larger company and it's sort of weighing everything else down and you look bad, even though it's not your fault, none of that would happen. And you could simply just say, yeah, look, that just sits there. That number goes up. It doesn't change anything, and the world keeps on spinning. I want to just quickly quote from an article that the Board of Governors of the Fed published in 2018 by Brian Bonas, Lauren Feistemel, and Jamie Noonan, called SOMA's Unrealized Loss. What does it mean? SOMA being the System Operating Market account, the main Fed account at the New York Fed that they do most of their trading out of, sort of the counterpart to the Treasury generally.
Where it holds all the securities.
That's right. So they say they're talking about a situation where we bought all these Treasury securities, but what if we want to unwind our balance sheet and sell them at a time when they may be trading for a face value lower than we would get if we held them to maturity. So you got a 30-year bond, if you held it for 30 years, it'd be worth a certain amount. If you try to sell it in year 2 out of 30, people might not want to pay the full value yet. And the Fed could hold it the whole time if it wanted to, but if it wanted to sell early, maybe it would take a loss on compared to when it bought it. They said, even under the very unlikely hypothetical scenario in which the Fed sold a large amount of securities prior to maturity and incurred a sizable realized loss as a result, the Federal Reserve would still be able to meet its responsibilities and financial obligations. In particular, from a monetary policy standpoint, the losses alone would not affect the amount of depository institutions reserved held with Federal Reserve banks and would have no effect on the conduct of monetary policy. Moreover, in the unlikely scenario in which realized losses were sufficiently large enough to result in an overall net income loss for the reserve banks, the Federal Reserve would still meet its financial obligations to cover operating expenses. In that case, remittances to the Treasury would be suspended and a deferred asset would be recorded on the Federal Reserve's balance sheet, representing a claim on future net earnings that the Federal Reserve banks would need to realize before remittances to the Treasury would resume. Given that a large portion of the Federal Reserve's liabilities are composed of Federal Reserve notes, which have no interest expense and are mostly collateralized by interest-earning Treasury and agency mortgage-backed securities, it's unlikely that the Federal Reserve banks would be in an overall net loss position for long. Importantly, we conclude by stressing that there is no reason to believe that policy actions would be affected by their impact on the Federal Reserve's net income. In fact, the fair value of the Federal Reserve's portfolio, as well as its earning gains or losses, do not affect the ability to carry out its responsibilities as the nation's central bank, which is to conduct monetary policy to achieve its statutory goals of maximum employment and stable prices. I thought that's about as clear as it needs to be. The only difference is they're talking about a loss they incur, and we would be talking about a loss that minting the coin would cause them to incur. And once again, we're back in that same dynamic we talked about earlier, where the same thing economically is good or bad, depending on whether the Federal Reserve gets to be in the driver's seat. There's no risk to its operations. There's no risk to its monetary policy. There's no risk to its balance sheet long-term. The only thing is whether we feel like we got to make the decision or not.
And on this point about losses, this is where a particularly interesting part of one of the 4 or 5 different places that Alfred Hart makes this proposal. I wanted to read a little bit from. But first, I'll show off my prop. Original first edition from one of his 20th century fund reports, talking about the economy circa the Korean War.
What's the name for those?
This one is Defense and the Dollar, Federal Credit and Monetary Policies. The other thing I like about this, I'll just point out, is it used to be in the olden days that you would just put random slogans on a cover. So this one has, our monetary defenses too must be ready. And I think we should sort of bring back the random slogans on a cover era of book publishing.
Get the drum roll, dun, 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 dun.
Yeah. And so, but one piece that he says after making this proposal about having the Federal Reserve issue its own securities, which he calls a tidier arrangement, and that they would be authorized to issue its own securities with terms and interest rates appropriate for monetary control purposes. He then goes on to say, but the advantage of such an arrangement lies largely in the central bank tradition that makes it thoroughly respectable for the Federal Reserve to take a loss for monetary reasons, whereas by its tradition, this is very painful for the Treasury. And I think that's an essential point, that the Treasury, as this sort of like, we're trying to minimize costs, the waste, fraud, and abuse type framing, is always trying to lessen the payments that are going out the door. And that isn't necessarily what's appropriate for its for monetary policy. There are potentially situations, and we can have that larger debate in another context, but there's potentially situations where paying a higher interest rate is beneficial on a monetary policy view, but of course would never be beneficial from the point of view of, the national debt, and we're trying to reduce interest burden. And the Treasury hates taking losses, and of course the Federal Reserve does try to avoid taking losses to a certain respect, but ultimately it does and certainly should follow through on the fact that it's trying to accomplish monetary policy goals, full employment, price stability, financial stability, and so on. And there are some other lesser ones that have been codified into law through full employment acts. That those purposes are the higher order purpose, and losses and worrying about losses is a second, third, fourth, not in thing, and not statutorily based at all, except in certain like limited respects, say around the 13.3 emergency facilities and so on. So paying interest for a monetary policy purpose, which is essentially what you're doing with securities, whether they be officially called Treasury securities or Federal Reserve securities, makes a lot more sense to have on the Federal Reserve's books and the Federal Reserve's responsibility than the Treasury's.
And of course, in a different generation, these would just be two identical looking certificates, but at the top one would say Federal Reserve and the other would say Treasury. But one of the ironies, of course, is today that the entire securities system, with the exception of the retail securities that are issued through Treasury Direct, the majority of the securities that the Treasury issues just exist as book entries at the Fed anyway. This is why Warren Mosler calls them a savings account at the Fed, because they only exist as an account right next to the reserve account on the Federal Reserve's balance sheet. If somebody wants to buy and sell securities with reserves, the Fed just moves one number up on one account and the other number down on the other account. That's it. That's all that happens. There is no other place. And one way to think about that, as I said before, fiscal money for fiscal policy and Federal Reserve securities for Federal Reserve policy. And it is conceptually neater and cleaner.
Yeah.
And one other thing I just want to make a real quick point on this is just throughout this whole time, we've been talking about setting interest rates and the interest rates different actors are paying. But none of these interest rates are market rates. These are all policy rates. There's no bond market in the middle. Jimmy Carville concerned about the bond market, saying, when I die, I want to come back as the bond market because they intimidate everybody. There's no bond market. There's no bond vigilantes in this story. This is purely about different policy goals between monetary policy on one hand and fiscal policy on the
other. And on that point, even at the time, Alfred Hart makes this point. He says, in practice, the Federal Reserve is custodian of a good share of the government securities owned by banks, and paperwork could be simplified by authorizing the Federal Reserve to hold time deposits where holders prefer. Now, of course, now it's all book entry, so that time deposits for holders preferred is irrelevant. It's now all book entries that are managed by the Federal Reserve. I mean, that's the funny fiction of all this, is that we have the Federal Reserve.
You wouldn't even need to build more accounting software.
You just change the name. The Federal Reserve is the one that does the book entry. It does the account keeping. It manages people's securities accounts, and those securities happen to be treasuries, but they could be simply Federal Reserve securities, and the Treasury wouldn't have to do that much different. It would simply, literally running the auction would be, would have to be transferred to the Federal Reserve. But in terms of all the bookkeeping and accounting and safeguarding and transferring and recording holdings, that is all already done by the Federal Reserve. As Kenneth Garbate again has a different paper that's very good on that point, and the conversion of Treasury securities to book entries managed by the Federal Reserve. It's fundamentally itself, you could say that the Treasury securities being Treasury securities rather than Federal Reserve securities is in itself mostly an accounting gimmick.
That's right. We need someone to come up with the hashtag, right? If mint the coin is the rallying cry for fiscal policy reform, what's the hashtag for Federal Reserve securities reform? I don't know, issue the Fed debt doesn't really roll off the tongue the same way, but maybe someone can go out there and help us in that front.
Yeah.
Well, thanks a lot. I mean, is there anything else you want to end with? I'm pretty much done.
No, I think this is a good place to leave.
Yeah, I mean, then let me just say one last thing, which is that I think often people think about this coin as just a sort of flash in the pan, silly gimmick where you blow up the regular budget process or the regular financing process, and then what next? What happens after that? Have you even thought about these things? Do these people proposing this even understand this system? And even if people disagree, hopefully, if you manage to make it through this entire conversation, you will at least leave with what I think is a correct impression that we have thought about these issues, and that there is a world on the other side of minting the coin that is not simply anarchy and chaos, but in fact might actually be a more coherent and more rational and more functional form of fiscal and monetary policy than we have today. And that these are not debates that came up out of the blue with the coin itself, but in fact the coin fits into a longer tradition, both of reforming the autonomy that the Treasury gets with regards to fiscal financing, as we've talked about elsewhere, but also about the coordination of fiscal and monetary policy, of Treasury-Fed relationships, and of reforming the securities market. And in a world where central banks do have an increasingly central role to play in financial market regulation, freeing them from their dependence on the Treasury may actually be an important step in the post-2008 monetary policy regime transformation that we've all been sort of watching and trying to push in certain directions. So thank you very much, Nathan. It's an absolute pleasure, and looking forward to having the next round of chats about this. We had Philip Deal first, and now we have you, and I'm very excited to see what comes next. So take it easy.
Sounds good.
Bye.